Let's understand the role of the trade life cycle steps of clearing and settlement as a part of the post-trade activities. I'm learning partner Sushila Hariharan. We've already discussed about the pre-trade checks that have to take place by an investment bank so that the bank is aware of who the counterparty is, what is the legal entity of the counterparty, are the credit limits in place for the counterparty, is there a market risk limit put in place for dealing room activities, etc. So the pre-trade checks and balances have to be in place before initiating the trade. This is the very first stage of the trade life cycle, because if this isn't done, then the bank is exposed to unwanted, unnecessary, and perhaps fairly expensive credit risk as well as market risk. So the pre-trade checks and balances must include steps that ensure that the bank has complete and total knowledge of whom they're dealing with, what is the legal status of the entity they're dealing with, as well as in place a complete understanding of market risk. These pre-trade checks are completed. The trade is then executed on different markets. I've already uploaded a video on understanding different market pricing mechanisms. These include the OTC markets, where typically there are orders, bid order, bid order, ask order, etc., which are fed into the system. A two-way quotation is provided on the system, and then the price is taken. Okay, so trade, many orders are fed into the system, and only if the orders are matched does a trade get executed. The method of execution of the trade in different markets vary depending upon how the exchange is put in regulations or what are the best practices and the best principles on the OTC markets. Irrespective of whether it's an OTC market or an exchange traded market, there would be a matching of orders for a trade to get executed. Only matched orders result into executed trades. This results into the post-trade activities, which start from understanding data enrichment. Let's understand the varying stages of the post-trade activities. Why do we call it trade life cycle? We call it a trade life cycle because it starts at point zero, completes 5 to 6 steps of a particular single trade and comes back to point zero. So just like we have a rolling market in the stock exchanges where every day can be a settlement date, similarly post-trade activities also start off with processing the trade at a particular point and thereby completing those stages and then coming back for the next trade. These stages are presented here sequentially, but most of them happen simultaneously because unless there is a clear financial default at place, activities would assume that the processes are going on smoothly and seamlessly. The first stage of the post-trade activities is data enrichment. Data enrichment means while the trade is booked at the front office level, while it is executed by the front office at the trading level, all details might not be captured. Therefore, through static data, through reference data mechanisms, you will want to enrich the data to get further details about counterparties, custodian, counterparties, bank details, etc. The trade is then matched by an independent matching agency like TRAX, TRAX, or OMGEO, OMGEO. The trade matching mechanisms ensure that there is an independent matching of the trades. And finally, there is a trade confirmation. A trade confirmation means that the counterparty is confirming the trade. With these 3 steps in place, the bank has got complete and total details with respect to the trade. That is, what is traded, at what price it is traded, and thirdly, how much it's traded. This ensures that the bank has all knowledge and an idea about counterparty as well as how much is the trade details. We now move into the financial obligation status of the trade. 3.4 is clearing. Clearing is a pay-in, pay-in in some markets, in banking and financial markets, as well as in many parts of trading mechanisms. We call this as clearing. To clear means to clear one's obligations. When you enter into a trade, you have to make a pay in of your part of the trade. If you're a buyer, you have to pay in the funds. If you're a seller, you have to pay in the securities. So clearing means to clear one's obligations as a part of the trade, depending on what is the trading position that you have taken. If you've taken a trading position of long position, then you have to pay in this funds. If your trading position is a short position, then you have to pay in the securities. Clearing itself can be of two types, that is a bilateral clearing or a centralized clearing. In bilateral clearing, where a trade is taken place directly between two counterparties, the clearing is the pay-in is done directly to each other. Over here, the bank is exposed very highly to counterparty credit risk. Therefore, many banks, in fact, globally, even if there is decentralized trading like in OTC markets of foreign exchange and bonds and money markets, there is centralized clearing wherein all the pay-ins are done to the central clearing house. The clearing house is a independent entity which receives pay-in from different counterparties, different traders, and then it matches the pay-ins of the different counterparties. So centralized clearing or a central counterparty is an important entity, especially in the case of OTC derivatives post the 2008 financial crisis. What happens next? Over here, we understand the role of two new entities who have stepped in at this stage. The first is the custodian. I've already uploaded a video on understanding what is the role of the custodian. Do take a look at that video. The custodian is an important entity in the trade life cycle because it is responsible for making the pay-ins. The clearinghouse is responsible for matching the pay-ins of different counterparties. So the custodian and the clearinghouse both put together are new entities whose role is very critical over here. We will understand the role of the custodian and the clearinghouse in another video because it's important to understand that the investment bank is now dealing with external entities. The financial pay-ins have taken place from the investment bank to the clearinghouse. There is now a stage which is important to understand, that the custodian and the custodian's role and the clearinghouse roles in understanding the clearing process. The next stage is settlement, 3.5. 3.5 settlement is payout. The payout in financial lingo is to receive one's entitlement. So clearing means to make one's commitment. 3.5 is settlement, to receive one's entitlement. We will always receive our entitlement if we have completed our obligation. Okay, there are two methods of settlement: DVP, delivery versus payment, and FOP, free of payment. Most trades are concluded and settled on DVP basis only, so that reduces the settlement risk failure of the entity. Settlement payouts will happen. So when we talk of settlement failure, it is actually at the caution or the awareness or the alertness will come if you have not received trade confirmations, if you have not received clearing settlements. Okay, so clearing itself is a stage where we will understand that there is a possibility of settlement failure. Thanks for watching. If you like the content, do comment, like, and subscribe.